Welcome back. For his take on our top line story and that market rally of earlier this summer, we're joined by our featured guest of the morning, Gavin Graham, Chief Strategy Officer at SmartBe Investments. Gavin, thanks a lot. We've got lots to talk about. Let's get to it. Your thoughts, first of all, on the labor news in the United States. The country was facing the possibility of a very large and potentially crippling rail strike. That looks like it's been averted. What do you think?
Very, very good news, because given the inflationary concerns that are already out there, given how much of US freight moves by rail, given the difficulty of finding any way of replacing that capacity, and also given the fact that while gentlemen like Bernie Sanders feel that the Feds ought to be getting involved in issues like this and should let unions and management fight it out, it is obviously very good news that it appears, from what the Labour Secretary says, that a tentative deal has been reached. And interestingly, because the unions are obviously in a much better position in an inflationary environment to actually get cost of living increases, but it's much more about things like quality of work and time off and stuff like that. So overwhelmingly a good news story if it ends up being, as it appears at the moment, as if there is going to be a settlement.
Lots has happened, Gavin, in the market since we last spoke with you here on the street. Most notably, we got another sky-high reading on U.S. inflation, higher than investors had expected. The markets have sold off. Your thoughts, and you've got lots of them, on the rally of the summer that has since faded, not entirely away, but has faded pretty significantly, on the I guess the reminder to investors that inflation is not over yet in the U.S.
Absolutely. And I think one of the previous times we were talking, Paul, it was ahead of Mr. Powell's speech at Jackson Hole, and everybody was, oh my gosh, he's really serious about getting on top of inflation. He's going to keep raising rates. And he talked for the 9 minutes about nothing except the importance of ensuring inflationary expectations didn't become unanchored and actually sort of get built in, and you start to have a wage price spiral. And then, of course, on Tuesday, we actually got the numbers, which, I mean, it's down from the record. It's down from the all-time high of, I think, 9.1 in June, but it was much higher than people expected. And we had the worst day in two and a half years because people were surprised. And again, it's difficult to think why they were surprised. You know, you do have inflationary pressures out there. You might have a rail strike. You might have exciting things happening in the Middle East or in the Ukraine. Why would you think that it's going to be easy to get inflation down? And why would you think, particularly, that the Fed and the other central banks have made it very, very plain they regard this as being priority number one, are not going to keep raising rates? So it looks like we're definitely going to have 75 basis points from the Fed next week. Some people were even talking a 1% rise, although that now seems to be dying away a little. But they're going to keep raising rates as well. So you should anticipate higher interest rates. The yield curve is inverted, with the short-term 2-year bond much higher than the 10-year bond, and that has been a precursor of a recession in the past.
So the question is, what were investors thinking when they were bidding the market up in June? And the answer is that they were thinking that a decline, a sustainable decline in inflation was coming in the shorter term. That wasn't the case. But you also say that as they were bidding stocks up, they were using their bull market playbook. What do you mean by that?
Yep. Well, effectively, and you can't blame them for it, but every time there's been an increase in interest rates in the past decade, whether it was in 2011, whether it was in 2018, the Fed has backed off once you started to see real pain in the stock market. Once you started to see markets down 15, 20, 25%, then there was a pivot. And so they were using that playbook to say, oh, it's going to be the same again. Mr. Powell has inflicted, sufficient pain. We're off 20, 25%. Lots of individual high flyers are down 50, 60, 70%. So he will do what he's done previously. The difference this time around, I think, Paul, is that previously inflation was under 2%. Now it's 8%. And the Fed and other central banks have lost credibility because they told us it was all transitory last year, and they turn out to be, now what is the technical phrase? Oh, yes, wrong. So now, to regain credibility, they are going to keep on needing to raise rates, and probably higher than they need to, because we're already seeing some signs of slowdown in the economy, but that's not going to stop them raising rates.
The biggest rally we saw among U.S. equity markets starting in June was in the Nasdaq. Investors were going back to the stocks that led the earlier rally, the stocks that were doing great things until November of last year.
Absolutely. But again, if you actually look at performance over the last 5 years, the Nasdaq's up just a bit under 100%, S&P's up 60%. Facebook, I'm sorry, Meta, I should call it now, and Netflix, the two sort of smaller members of the FANGs, are actually up less than that. They have actually been underperformers. It's really been, increasingly crowding into those, the Apples, Microsoft, Amazon, Google, stroke Alphabet. Those are still up 150, 250%. And again, it's difficult to see how things get much better for them if the economy is slowing. A lot of their sales are dependent on advertising and consumer sentiment. Who needs a new Apple 14, if it's not a really massive upgrade on your previous one, if things are getting tighter and the cost of your mortgage is going up. So it's understandable why they did it, but realistically, ladies and gentlemen, you should be looking at other areas like, for example, energy, or something maybe we can talk about a little later, Paul, defensive sectors that have actually been holding up pretty well.